Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas. I teach intermediate accounting, both 1 and 2. And today's lecture is for my intermediate accounting 2 class. It's around chapter 13 from the Spiceland, Nelson, and Thomas textbook, a McGraw-Hill textbook, a great textbook. I'm going to give them credit here right up front at the beginning of this video. And today we're going to work problems from chapter 13 around current liabilities and contingencies. So I wish you well. I'm going to share my screen and get started here. I do enjoy working problems because this is the way to learn. And I strongly encourage you to stop the video. If you're watching this on YouTube, stop the video. You work it yourself. And even if you screw it up, you don't know it, and you screw it up badly, at least you get your head into the problem versus just listening to me talk. And then I'll work the problem, and then you'll learn it. If you still don't understand it, go back to the textbook or go back to my lecture on the in the first lecture for this chapter. I do give you a summary and go through PowerPoint slides. So today's lecture is working problems. So with that, share my screen and get to work. You know, one thing I'm gonna do here, I just want to make sure this thing is recording. So I'm going to stop my share. It is recording. You know, I would hate to spend, 45 minutes doing this and then find out it was not recording at all, and I'd have to redo it again. And that has happened before. So I'm not going to ever let it happen again, because I got other things to do. I know it's surprising, but I do. So with that, let's get started. Get this so it's there, and then get rid of my, that's probably okay. All right, let me get rid of my little floating panel here that you cannot see. Okay, also this is 13-1, and this is around notes payable. There are 3 entries related to notes payable that you need to know. And this is asking you for all 3 journal entries. So with that, I'm going to give you just a second here, pause the video, and go work this problem. Welcome back. I hope you just know how easy this one is. Even I do this kind of problem in my principles class. So on October 1, the Elder Fabrication borrowed $60 million with a 12% promissory note for 9 months. So they're going to use this money, $60 million, for 9 months. And at the last day of the 9th month, they have to pay 2 things. They got to pay the $60 million back. That's a lot of money. And they have to pay the 12% interest on that. So entry 1 is easy. Elder receives cash, and they credit notes payable. Okay, now if we go through, say, 3 months in the first year and then 6 months, so this will not be paid till June 30th of next year. And so throughout that entire 9 months, we are incurring interest every single day. Elder Company Fabrication incurring interest, because every day a company is using someone else's money, there's interest expense, whether it's paid or not paid. The interest expense has happened. And so when we're closing the books on 12/31, we've got to record interest expense. But we haven't paid it yet, so we're going to credit the interest payable. Again, this is the second entry that you have to know for this particular topic, notes payable. We're going to cross over an accounting period. So from October 1 to 12/31, there was interest expense. So I use a simple method to do this. I use it regardless, how easy it might be. I calculate first, what is the interest for 1 month? Pretty easy to do. So times the 12%, Keep in mind, interest rates are always a 12-month rate. So I got to take this and I got to so let's just do the annual amount of interest. If this was outstanding for an annual amount, I think the answer is 9 million, but I'm not going to trust myself on live TV here. Oh, good thing I didn't. It's 7.2 million. So if this loan had been outstanding for 12 months, elder fabrication would incur and have to pay 12 months of interest. Well, it's only been outstanding for 3 months, we know, but let's go divide it. How much is it per month? Well, again, I'm not going to trust myself. 600,000, 0.6 million per month. And now that I've calculated this, hey, give me your problem. I know how much it is per month, so I can do anything. So how many months has this note been outstanding at the date of 12/31? October, November, December, 3 months. So interest expense is going to be equal 0.6 times 3, 1.8 million. If it was allowed by the contract, by the note payable contract, and they wanted to pay off the loan early at 12/31, so it's not on their balance sheet or whatever, they would have to cut a check for 1.8 million. So they have, and we're in the current liabilities chapter. So this is a current liability. That 1.8 million is going to be paid at the end of the 9 months. So that's 6 months from now. So, and that brings us to the third entry at the very end of this note, June 30th, October, November, December, January, February, March, April, May, June. Nine months. I like to count on my hands. I don't want to be a rocket scientist here. I just want to get this thing right. And that's, how I would do it if I was doing an exam, by the way. Now, this next entry, we're going to, again, have 6 months of interest. So we're going to have interest expense for the 6 months. And we're going to pay this. So this interest payable, that was a credit to the interest payable account. Well, now we're going to pay that off at June 30th. We're going to pay that interest so we can get rid of that interest payable amount. Remember, debits or credits. We set up a liability with a credit. We get rid of it. And you already know the answer to that. That's going to be paid. By the way, this note payable set up with a credit as a liability, that's now gone because we're going to pay that off. So debit the notes payable. And we're going to credit cash. How much did we pay in cash? You could do this several different ways. I could just go calculate 6 months of interest expense. I know what the note payable is. That's 60 million. And then I could just add those together, and I know my debits and credits have to equal. But I'm going to do it a little slower, and I'm going to say this cash is going to equal 60 million plus 9 months times 0.6 million per month interest. So every month this note is outstanding, the company is incurring interest expense and has to pay 0.6 million. It's been outstanding for the full 9 months. So that's going to be 60 million plus 5.4. So the company is going to have to cut a check for 65.4 million. Or they're going to have to declare bankruptcy, and whoever owns this note's going to come after their assets. So you can guarantee they're going to cut that big, large check. So 2 ways of doing this. Well, I would do this no matter what. Make sure my debits and credits are equal. So 65.4 and 1.8 minus 60 minus 3.6 million. So interest expense is 3.6 million. Does that jive with what we think happened? Because this is interest expense for 6 months. So 6 times 0.6 per month equals 3.6. Check. When you have to do this problem on the exam, I hope you get this problem on the exam. It's an easy one, and you can check your work. Are the debits and credits equal? Do my interest expense, does that work? Now notice what we've done here. I always like my students, we're measuring in accounting, but we're also reporting. How do we report? That's in the income statement, in the balance sheet. And so what we've done here is, let's just go back to 12/31, the prior year. We put $1.8 million of expense in the prior year. And why did we do that? We did that because that note was outstanding in the prior year for 3 months. That 1.8 million of interest expense is real, and it happened in the prior year. The remaining 3.6, that happened in the next year. And so we've got the income statement right in both the prior year and in the current year. Not only that, we've got our balance sheet right at 12/31 because we owed $1.8 million of interest. So this is, what adjusting entries are all about. Okay, I'm going to work the next problem. Before I do, I just want to talk a little bit about, well, I think I have one more notes payable. Let's just see. Let's just do the other notes payable problem. Let's do this, and then we'll talk about accruals. All right, again, you know how to do this already. This would be like clearly how multiple choice would work on an exam. So I'm going to let you guys, I'm going to pause you just for a second, pause the video, go work this, and then come back and see if you got it right or not. All right, practice makes perfect on this. And so this is a 1-year note. That started, began April 1. I'll do the journal entry really quick for April 1. That's not what they're asking for. Debit cash for $360,000 and credit notes payable for $360,000. But what they're asking for is 12/31. Our second entry is always going to be that same, that adjusting entry is not going to change. If nothing else, and you can't calculate this right, your professor, including that would be me, probably give you some credit, at least if you try to debit interest expense and credit accounts payable at the interim date. And this note does cross over. If it didn't cross over, if it got paid in November, we wouldn't have this entry. But this note is still outstanding. This interest has been incurred since April 1 to 12/31, but we haven't paid it yet. So we have a liability. We owe this interest, and we've incurred the interest expense. Now, I like to follow my process. How much is the interest expense per month? 360,000 times 10% equals, I can do that math, 36,000 per year. So if this note is outstanding for a year, we would incur 36,000, but that's not what I'm interested in. I want to, how much is it per month? That's easy. I know how many months are in a year, divided by 12, 3,000 per month. Easy. So what's my journal entry at 12/31? It's going to be 3,000 per month times how many months? I'm going to count them on my fingers so I don't screw up. April, because the whole month of April, if that was April 30th, you wouldn't count April. That's why I sometimes use my hands. April is in, because this note was outstanding for the whole month of April. April, May, June, July, August, September, October, November, December, 9 months times 9, 27,000. So my interest expense that I got to record as an adjusting entry is 27,000. But it has not been paid. It will not be paid to the last day of the note. So therefore, I've got to credit that interest payable. Question asked, how much should the company accrue for interest on December 31st? The answer is C, 27,000. On 4/1 of the next year, just to do this problem really quick, that's our last entry. We're going to have interest expense we're going to have to get rid of our interest payable. Again, you could be asked about any of these three entries or required to do these three entries if we're going to give you a pre-response question. And I got to get rid of my notes payable. How do I get rid of these? I have to pay. How much do we pay? $360,000 plus a full year. So I already know what a year is, plus 36,000, because this is a 1 year note. So I'm not have to do my divide by month thing. I already calculated how much interest is per year, and this is a 1 year note. So I'm going to have to pay $396,000. Credit cash of $396,000. Get rid of my notes payable, $360,000. Get rid of my interest payable, $27,000. And so I've got $396,000 minus $360 minus 27, $9,000 of interest expense in the next year. Last year, we had $27,000 of interest expense because the note was outstanding for 9 months of last year. It's only outstanding for 3 months of this year. By the way, 3 times 3,000 equal 9,000. This is notes payable is just so easy. You know, if you don't get this right on the exam, I just say, you know, shame on you. You got to get this right. You got to understand how interest works. And, you know, sometimes say even for your life, you can be a finance person or whatever you can do in accounting, you've got to understand interest expense. Again, it's if we're using someone else's money, that's an expense for us. We're incurring interest expense every day at the annual rate of, you know, divided by whatever period of time it's outstanding. So if the rate's higher, higher interest expense. If the term it's outstanding higher, because every day incurs the same amount of interest, the interest expense would be higher. Well, before I get to the next part, just going to go back and revisit, you know, kind of what we have been talking about in this chapter. You know, we have two types of entries, adjusting entries we're going to look at. One is what we call an accrual. The cash is going to be paid later, but we have an obligation now. Go back to the definition of a liability, right? That something has happened prior to the balance sheet date. You know, we've received something or something has happened that's triggered an obligation as of the balance sheet date. And that obligation will be paid later, either in cash or we may have to do something, you know, as we'll see in deferrals. So an accrual is when cash is going to be paid later. And at the balance sheet date, we are kind of estimating. We're going to estimate things like warranty costs. And we may not know how many warranty claims would come in. We're going to be, I'll say guesstimating, because we're never going to be perfect there, but we have past history to know to get it very close to reasonably accurate. And, you know, when I see it from the companies I work for, we got it pretty close to reasonable accuracy. And so that first entry at the balance sheet date, we're going to debit expense and credit a liability based on an estimate. And so back to your debits and credits, we create that liability or add to that liability at year end with this journal entry. Later, we're going to incur warranty claims. If we're an automobile dealer, our customers can bring in their cars in and say, hey, this isn't working right. You've got to fix it, you know, because you owe me, you know, you owe me a warranty liability. That obligation set up the date of the sale of that car. So when the car dealer or whatever business the company's in handles that liability and pays cash for it, we're not going to record expense because we're accrual based. We already recognize the expense. We're going to reduce the liability because we've taken care of part of it. Now, always get asked this question in class, and it's just, by the way, just a great question. You know, boy, I know we're not going to be perfect estimating these warranties. So what do we do later when we find out that our estimate was wrong? Well, in future periods, we're going to make an adjustment to that liability. And the offsets will either be, if we increase the liability, we're going to add to expense. If we reduce the liability, we're going to reduce the expense in that future period when we find out our estimates were wrong. For example, if our warranty claims are running at 5% of sales, and we recorded a warranty expense and liability here at 5% of sales of this particular year, and then we find out, hey, our quality got better. It's only running at 4%. So what's going to happen there? We're going to make an adjustment, and we're going to debit the liability because our estimate was wrong, and we're going to credit warranty expense, reduction of warranty expense. We can't go, this one does not require a restatement of the prior year. We allow those adjustments just to happen in the current year as we figure them out. And there's a whole chapter, by the way, on accounting changes that you will have later in this course. I think that's chapter 20, but don't hold me to that. All right, so that's an accrual. How about a deferral? And a deferral happens when not the cash is going to be paid later. We've received cash now. Why are people, is it a donation? Hey, Mr. Airline, I'm going to donate to you $3,000. And if you feel nice to me, why don't you give me an airline flight later? No, we are not donating. It is not an option for the airline to say they're not going to fly me if I've already paid them $3,000 to go to somewhere wonderful, right? I'm expecting they owe me an airline flight. So when the company receives cash up front, they've got a liability. Now, there's two different names I've seen for this. One is unearned revenue. One I'm most used to is deferred revenue. Now, people get confused because it's got the word revenue in it. And they immediately think, oh, revenue, that's an income statement account. I got that. Credit to that, put it on the income statement. No, why? The word deferred, that means delayed, later. We'll recognize revenue later. Unearned is another good word for this because you haven't earned the revenue. All you do is have cash in advance. Therefore, this we receive the cash and we credit this liability called unearned revenue, deferred revenue. Another way of saying this is we don't owe them cash. We owe them a service or a product if they paid in advance for a product. Or if you give Amazon Prime $200 at the beginning of the year, they owe you free shipping for the entire year, right? And so they have a liability like that. Or a gift card. We talked about gift cards. You buy a gift card for a restaurant, for Chili's, that's my favorite one. They get the debit cash for $25 because I paid $25 for a $25 gift certificate. But they don't get the credit revenue because they haven't given me any food. You know, we're measuring activities. They've done nothing. They've just sold me a little card that means nothing. I take that card in and I get my $25 worth of food and margaritas or whatever. That's when that liability gets reduced. So when that service gets performed, when we take the airline flight, when the airline's customers take the airline flight, when Chili's customers redeem their gift cards and receive a meal, now we're at the second entry. They don't owe that anymore because they've done their job. They've done their duty. They've satisfied that liability. And when how do we reduce the liability? Debits. We set it up just like this entry up here. Same thing. We credit a liability and debit expense. Here we're crediting a liability and debit cash because it's related to revenues, not expenses. And then when Chili's redeems that gift card, gives us our food and our drinks, at that point they can credit revenues. So they will debit the liability and credit revenues. So this is really what we've seen here already in this lecture is the whole chapter, pretty much. This is the concept of the chapter for accruals and deferrals. And remember on notes payable and interest, slightly different thing. Really, you know, if you think about it, if I bring this back, it's still kind of the same thing. I am crediting, you know, a liability and debiting expense. So it follows this accrual, credit the liability, debit expense. This case, my liability was interest payable. And later, I'm going to debit the interest payable, reduce that, and credit cash. So even though we looked and the interest kind of confuses things maybe, or put some noise around it because there's other things going on, but basically we're back to this entry, even with notes payable. So basically this is the chapter right here. You understand this and apply it in every concept we're going to talk about. So that's enough of preaching there. So I know you guys will do that. You know, if you're watching this, you're probably a pretty good student, you know, to put up with my lectures. That's for sure. So let's go to the next one here. And again, I'm going to let you read this. This is a hard one, and it's gonna take some interesting thought process. There's a lot going on, so I would strongly encourage you to use the concept we just talked about and record vacation expense and the vacation payable. And this is they want to know, hey, what were the balances in the vacation accrual at the end of the year, and what was vacation expense for the year. So this is making you go through all the journal entries required here. So, you know, please pause. I'm going to pause. You pause the YouTube video. Go work this. I cannot say it strongly enough. Practice makes perfect. Okay, welcome back. I think you probably saw this was a pretty hard one. And so let's just go through some of the important data here. And we see the hourly wage is $15, and the employees receive 2 weeks of vacation each year. Unused, this is really important here, unused vacation can be rolled over to the following year. So at the end of the year, we're going to have a vacation payable. But guess what? It still has this other little quirk in it. It must be used within 1 year following the end of the year. So if you don't take it by the end of the next year, you lose it. So we got to consider that as we go through the data again. So let's just look at this. And I'm going to use T accounts. We got our vacation accrual and our vacation expense. Remember, this is a liability. This is going to have a credit balance. This is an expense, a reduction in equity, a reduction of net income and retained earnings all the way through. It's going to have a debit balance. So let's just see what we got. So at the end of the fiscal year 2015, there was 300 hours that had been earned but not used. All right. So I've got, you know, how much do I owe them? 300 hours times how much did we pay them per hour? 15. So 300 times 15 is 4,500. And that's 300 times the $15. So that's what we end the year 12/31/15. That's what's sitting as a liability on our balance sheet. Okay, during 2016, now let's look at the activity during the following year, 2016. Employees only use 200 of the 300 hours. Well, you get the record the use. They used 3,000. That's, you know, 200 times 15. And so that's just a reduction, you know, so debit the vacation accrual, and they'll have it on here, but credit cash or whatever, right? They got paid for that. So credit cash for 3,000, debit the vacation accrual. Keep in mind, we set up the accrual with the credit and we reduce it with, you know, a debit. Now, you got a little issue here. We expected them to use 300, they only used 200. We've got to go make an adjustment. This is what I talked about. If your estimate was wrong, this was the best guess estimate we had. I would always assume my employees are going to take all of their vacation. I don't know what's going on here. They'll leave 100 hours on the table. Not something I'm personally going to do. I'll tell you that. So, so there's 100 hours left behind. So as I said in the little setup before doing this problem, that gets adjusted. And so 100 times 15 I reduced my accrual. Why did I reduce it? They lost it. Remember, they don't use it in the next year. They didn't use the 300 hours in 2016. They used 200. I reduced the accrual, but they lost 100. Now, what's our credit here? Not cash, because they didn't take it. So this is interesting. An adjustment to the accrual goes to vacation expense. I'll see if I can tie these together. That's one, that's two, that's three, that's three. So this is debit the vacation accrual, credit expense. So this is another thing that happens with all approved liabilities, because we're always kind of guesstimating what the future cash payout's going to be. We missed it. We thought it's going to be 4,500. It was only 3,000. You know, I look at it from two perspectives. One, the employees screwed up. It was bad for the employees, but guess what? It was good for the company. We got an extra 100 hours of work out of these employees. I mean, this is big, you know, not from my perspective, but, you know, from the management's perspective, they got an extra 100 hours of work, basically kind of for free, because they earned a vacation, didn't use it. And so it's a credit to expense, a reduction of expense. All right, enough said there. Now they earn an additional 1,000 hours of vacation in 2016. So we got 1,000 times 15, you know, so we're going to credit our vacation accrual for 15,000, and we're going to debit expense for 16,000. We call that 4. This is our normal, you know, first entry, debit the expense, credit the liability. They earned it. Now they also used 900 hours. They earned 1,000. They used 900. So we got to reduce our accrual. 900 times 15, 13,500. All this number 5. By the way, debit the vacation accrual, you know, credit cash. I'm not going to put the cash account out there. Just you have to think about it. You guys are smart enough now in the intermediate to figure this out. And again, this is how we do T accounts a lot in the real world as well. So again, 1,000 hours and use 900. And so we debit that. And so again, this is that second entry we talked about. This is, you know, reducing the accrual because they use their vacation hours. And that's it, we're done. Let's go to close the books. We've got $13,500 of vacation expense. I'm just saying my debit minus my credit. And let's see what we got here. This is 19,500, 16,500, 15. I'm down to 1,500. My final balance on my vacation is 1,500, and I'm just taking my credits minus my debits, you know, posting my journal entries. Now my auditor comes by and says, "Hey, Mr. Rumbo, can you please verify that balance that you've got on your balance sheet?" And they're not going to be happy for me. Let me show you all my journal entries. No. What's your liability? Tell me what it is. You know, that's easy. We gave our employees 1,000 hours vacation. They used 900, so they have left 100 hours times 15. I can verify that number. And so in accounting, we always have a second check, if you will, to clarify, you know, what does our balance represent? So that's a pretty cool problem. You know, that really shows a lot of the stuff that works here in this whole chapter. This really brings a lot of the chapter up front, especially because we have the adjustment, you know, and that in this case reduces expense. For some things like warranty, maybe the warranty expectation is higher than we originally expected. So we could actually, you know, add additional accrual in the second year and debit expense. So it could go either direction. You may just note that. All right. That was a hard one. This one's, I think, a little easier. This is back now we're in the second area of journalism we talked about for this lecture. This is a deferred. In other words, we're receiving cash up front, $120,000. This is how this works. I've been involved. A lot of companies turn over their web hosting or a lot of their computer services or computer maintenance to other companies who are really good at that, give them an upfront fee for 12 months of service. That happens a lot in business. You would not, you'd be surprised. So take a look at this, pause the video, you try to work this. All right, welcome back. So I'm gonna do all the two entries here for this. So on 10/31, the company received cash of $120,000, and but they do not get to recognize revenues. They have done nothing yet. On October 31st, all they've done is said, thank you for your money. We'll take care of you. And what are they going to do? They owe them web hosting services. For how long? 12 months. And they begin on November. We're going to have to credit a liability. Now, it could be called unearned or deferred revenues. And so again, don't be confused by that account. Focus on these words, unearned. We owe them the services that will become revenues for us in the future. And so they're going to go for 12 months. Now, here's the problem. We're going to cross over a reporting period, 12/31. And, this contract is not over, but guess what? We've done web hosting services for 2 months, November, December, 2 months. So we've satisfied 2 of the 12 months of our obligation. So we need to reduce our obligation. But how do you reduce a liability? Debit. And guess what? We've done work for 2 months. We're measuring activity. We've done our work. We're doing services. Credit to revenues. And so we're going to, that entry, debit to earned revenue, credit, real revenue. This is a balance sheet account. This is an income statement account. Now I do these kind of like the way I do notes payable, because I'm going to say how much it's a good methodology for doing this on an exam, especially. How much is the company earning per month? They're doing $120,000 they received, and it's for 12 months. I divide by 12. So another way of thinking about this is every month they provide these services, they earn $10,000. They've already received the cash, so there's no receivables involved. Deferred revenues are actually good for a company. You'd always rather get your cash up front and then do the work, right? That's a really cool deal. Think about the airlines. If they said, you fly, if you like your flight, you pay us. If you have any complaints, we can maybe discount. Airlines have too many problems. Give me your cash now. And you say, I have problems. Well, just report it. We'll see if we can fix it. But they're not giving you any cash back, right? So for businesses, it's good. In some business, almost required. Take the cash up front. And so airlines have really big liabilities for deferred revenue. Amazon, I think I looked at on the financial statement, they got a big deferred revenue for all that money they're collecting for Prime accounts. So how much revenue do we get to recognize? $10,000 a month times 2, 20,000. So we get to reduce our deferred revenue by 20,000, and we record real revenue for 20,000. Let's just look at the T account. Again, unearned revenue, deferred revenue, same thing. We set it up with 120,000. And on 12/31, we have a final balance. We're going to debit it for 20,000 for 2 months. And at 12/31 on the balance sheet, we're going to have a $100,000 liability for deferred revenue related to this contract. Again, my auditor said, hey, verify that. It's easy. I say, I had a 12-month contract. We've done 2 months of the work. I've got 10 months left. 10 times 10,000 a month. Voila, 100,000. Measuring and reporting. And so it's good for users of the financial statement to know. There's a couple things you get from looking at deferred revenue on a financial statement. There's a liability there. Some service work got to be done, might have some costs associated with it. But also I know those revenues are going to turn into real revenues next year. We already have the cash. So it's good that you would look at the deferred revenue account year over year. You hope it's growing if you are investing in the company, because that kind of tells you that good things may be happening in the future. All right. Again, this Folsom company is refinancing some of its long-term debt. So some of it is probably due, however, how would the debt be classified if the refinancing is done before the year end, 12/15/2018, and some of it got refinanced January 15th, so after the balance sheet date. But guess what? Before the financial statement date. Kind of two new terms for you. We have our normal balance sheet date, and normally would say whatever's current or long term on that date, that's what matters. Here, the rules give you a little bit of a break. And so in this one, the answer is C, it's a long-term liability because we got it refinanced before the financial statement date. Okay, just something you're going to have to know. You could definitely see the exam question on this one. All right, just got a couple more. I'm gonna let you take time to read through this. I'm gonna actually I'm not gonna make you pause the video in this case. I'm gonna let you just read through this for a minute. So this was a real world circumstance for me. It wasn't the Mean Green Appliance Company, but there's a possible faulty dishwasher. Not sure about it. And the company has actually been sued because there was a fire, that happened. So by the homeowner, but maybe it's just not one home. So we'd have to look at this one lawsuit to see, is it probable? What are the likelihood that we're going to win or lose this lawsuit? We got to consider, are there problems with all 300,000 dishwashers? Do they have similar issues out there? And that would turn into a recall and, urgent recall, because we cannot let our homeowners get hurt in a fire. And it's a law, Consumer Product Safety Commission, I think it is, that controls these. And so this, guarantee you, in my experience, the lawyers were deeply involved in this. And I was best friends with the lawyers because I got to make sure, hey, what's the likelihood of this becoming a recall? Well, guess what? It appeared that it was reasonably possible. Yeah, it's quite possible, but it's not probable. We don't have any information that would tell us it's probable. Well, and boy, it's reasonably possible we could have a charge of 30 to 60 million. Oh my God, if I'm an investor, that does not sound good, right? Well, you go to the rules. You only record that 30 to 60 million if it's probable. And you can estimate it. Well, we can estimate it already, but it's not probable. It's only reasonably estimable. So there, I mean, it's not probable, it's only reasonably likely. So reasonably likely or reasonably possible, we do not accrue the expense, but we do disclose we've got a potential recall that's could cost us 30 to 60 million. So now, if later we take that charge, I guarantee the Securities and Exchange Commission will come back and say, why didn't you think that was probable? Because they always get the hindsight to look at things. Securities and Exchange Commission are reviewing companies' financials every year of public companies, and they could come back and challenge this. And so you better have, by the way, we had a really good white paper describing why we did not think it was probable. There was other data involved, and maybe, we looked at this fire, there's other possible causes of the fire, not just a dishwasher. So there was a big white paper written to answer this question. Next, and these are not polling questions because I don't know when you're watching this video, but again, I'll give you a minute to read this. Okay, so Skill Hardware is a plaintiff in a $16 million lawsuit filed against the supplier. And litigations were really close, and it's virtually certain, almost guaranteed. That's like 95, 98, 99% certain, virtually certain. Probable, a lot of people say, is around 75%. So this is much higher than probable, almost guaranteed we're going to get this 12 million. So why can't we report a gain? So I want to, debit receivable and credit gain, and I've been in this situation, and you're not allowed to report a gain. I got something going on here. All right, gotta take that phone and put it in another room. So another extended warranty call sounded like they were sent there from Amazon, but I doubt that. Well, they're really trying to get me today, but they're not going to. Wouldn't you love for me to answer that right on this YouTube video and give them the runaround? That's what I want to do with all these extended warranty calls. Well, anyway, even though it's virtually certain here, you do not record anything. Look how tricky that could be on an exam. Next. Spam risk from Orange Park, wherever that is. They want me to get that extended warranty, I guess. I better turn that phone off before I do my next video. Okay, now we're to the next one. All right, again, this one you definitely can pause the video and try to work with. We're going to do two of these. These are warranty, two warranty multiple choice questions here. Okay, let's just get started here. So again, this is back to those same three entries that I've been talking about, right? So the Main Green Appliance Company provides a 1-year warranty for every product sold. And we know, hey, on average, we pay $25 per unit every time we sell one of these. And so we sold 100,000 units in 2016. We paid claims of $1 million. What was the warranty expense for 2016? This is really, really easy. The first entry, debit warranty expense. And credit the warranty. As you remember, from this beginning of this chapter, I told you there's only 2 entries you got to know. Well, really 4 entries, but 2 sections: accruals and deferrals. When we receive cash up front, we're going to debit expense, credit the liability, and when we pay it, we reduce the liability. So, I mean, this chapter is basically, do not be intimidated. This is easy stuff here, really easy. It's going to get a lot harder for my intermediate 2 students, a lot harder in the future chapter. This is opportunity for your grade right now. So the warranty expense, we sold 100,000 units times $25, and that's going to equal 2.5 million. So there you go. Warranty expense for 2.5 million, and we're going to credit the warranty liability. And what's really important here is timing. We record the warranty expense with the revenues. So if we close our books every month, some companies do that, and we record revenues for that month, we're going to record the warranty expense for that month. In this case, it looks like the company only does this for a full year financials. That's a very rare company. Most companies are doing monthly or quarterly financials. And so we want to match that warranty expense with the revenues. And a lot of people get tripped up on multiple choice questions. When do you record warranty expense? At the time the unit is sold. Because think about it from your own personal perspective. When you drive your new car off the lot, that 1 second later, they owe you a warranty for that car. And so when you drive that car off the lot, that's when the car company is recording revenues. And at the same time, they've got to record the liability that they owe you that warranty for all the future estimated costs. So that's where you get to the 2.5 million. And that's important because it matches up the revenue, the good guy, and the expense, the bad guy from the company standpoint. Now, the second entry here, they did pay claims of 1 million, so I'm going to debit my warranty. I don't think they're asking for this, but let's do it anyway. For 100,000, for 1 million, they tell you that, and credit cash. But what happened to the warranty liability? We set it up with 2.5. We debit for 1. We've got $1.5 million warranty liability. But what was the warranty expense? 2.5 million. Answer D. All right, the last one for chapter 13. Again, please read it and pause the video and work the problem yourself. This is a good one for you to work. All right, let's get going here. Again, I'm going to do this one just with T accounts. I'm not going to do all the journal entries, but please remember that there's journal entries behind these. This is, okay, it's got the word warranty on it, but it's so similar to the vacation problem I worked earlier. I'll tell you what, I'll go ahead and put the cash account on there. Which I didn't do last time. Maybe it'll make it easier for you. So, all right, warranty costs are estimated $25 per unit. We got that. They sold 100,000 and units. The paid warranty claims of them 1 million and 500 for 2016. We've got to get this beginning accrual balance 600,000. So the beginning balance. I hope you understand why that's a credit. You know, that's a liability, you know, that they owe warranty from 2016. And it's a 1-year warranty. So this 600,000 is going to be that all the claims around that 600,000, they're going to be at zero at the end of 2016. This was a 12/31/15. So these were for a 1-year warranty. So they're going to be gone. So, and let's just look at what they, well, we'll go ahead and we'll do it, you know, at once. They sold 100,000 units at $25 per unit. So we'll go ahead and record our warranty expense. And that's going to be 25 times 100,000. That's going to be $2.5 million. Warranty expense, right? Make sure I got 200,000. Yeah. $2.5 million. Boy, my handwriting is so bad. I know this is terrible for you guys, but there, yeah, that's better. 2,500,000. So that's just the entry, and we record this because these are the units sold in the current year. So we record revenues for these units. We got to record the expense for those units. Now, they paid claims of $1 million for the units sold in 2016. So these are for the $1 million. So credit cash, and we reduce the liability. So of this $2.5 million, we took care of $1 million of them. And then also we took care of 500,000 for this 600,000. Now, guess what? You guys see the problem here? We were expecting $600,000 of claims in 2016 for units sold in 2015, because only a 1-year warranty. So if it was sold, like all of them were sold December 31st, by December 31st of 2016, we're done. So we missed this estimate. We thought it was going to be 600,000. It's only 500,000. It's just like that vacation report. This is now what we call the adjustment. So I got to adjust this down because I missed it. I missed my estimate. And so we're going to reduce that 600,000 has to go to zero. How did that happen? $500,000 claims paid and 100,000, you know, just debited because it's gone. It was good for the company because we had less warranty claims than we expected. Awesome. You know, that's good news. And that good news gets recognized in warranty expense. So any change to that liability, up or down, the offset goes to expense. If that had become 700,000 here, then we would have to come back and we would add that to expense. We would have to adjust that. All right, and so let's see, we got anything else? I think we're done here. Got my million, got my cash there, I'm checking my math. All right, what's warranty expense? My debit of 2.5 million minus 100,000, 2,400,000. I don't think they asked for this, but let's do it. 3.1 million minus 1.6. Can you verify that? I can. I estimate, based on past history, at $25 unit, that I'm going to have $2.5 million of warranty claims for these products in 27, you know, in 2016 or 17. It's a 1-year warranty. $1 million got paid out of that. So what I've got left is $1.5 million. And how about this? The auditor said, hey, it's only a 1-year warranty. That has to go to zero. And it went to zero with these debits. So this only relates to products sold in 2016, because again, it's a 1-year warranty. So you got to use some critical thinking here and give this some logic on this. So I hope the problems help you see contingent liabilities and more importantly, accruals and deferrals, more easily by seeing it in real world, kind of real world these are for some of these definitely true, based on a true story, if you will. So with that, I thank you for your time, and I hope this was beneficial to you. And next, I'll be moving on to chapter 14. Thank you.